Good morning, everyone. I am Dr. Piyush Singh, Counselor, Embassy of India, Berne. I welcome all of you to this MISSP webinar today on opportunities in the Indian commodities trading sector. This webinar is part of the MISSP webinar series that we had inaugurated last year in April amidst the ongoing corona pandemic. Till date, we have organized 17 webinars focusing on various industry sectors. In today's webinar, we will focus on agriculture, metals and minerals, and energy. MISSP, which means Momentum in India Swiss SMEs program, is being run by the Embassy of India, Berne, for providing hand-holding services for Swiss businesses engaging with India. It enables Swiss companies getting introduced to India, exploring opportunities in India, and entering India. I am happy to note that in the last 1 year, we have been able to onboard 89 Swiss companies on MISSP platform. Our main partners include MISSP Knowledge Partner, T&A Consulting, and MISSP Legal and Tax Partner, Roddle and Partner. Friends, commercial contacts between India and Switzerland date back to the early 19th century. The India-Switzerland Treaty of Friendship, signed in 1948, laid the foundation for a strong economic content to the bilateral relationship. Today, Switzerland is the 11th largest trading partner of India, with the total bilateral trade in financial year 2019-20 being around US 18 billion. However, the fact remains that most of this trade is in the form of bullion being traded between the two countries. Today's webinar is also an attempt to diversify this bilateral trade between India and Switzerland. Friends, today the people of India have taken a solemn resolve to build Atmanirbhar Bharat, which means self-reliant India. It does not mean reverting to economic isolationism, but to ensure India's position as a key participant in global supply chains. It merges the local with the global. It ensures India's strengths act as a global force multiplier. Structural reforms and relief measures under the Abhiyan cover every section of the Indian economy. The new India is driven by the philosophy of Vasudhaiva Kutumbakam, which means the word is one family. Today, India is being referred to as the pharmacy of the world. India is among the few countries that provided essential medicines and essential medical assistance to more than 150 countries, despite so many difficulties during the pandemic. In a short time, not one, but two made in India vaccines have been developed. Many more vaccines are also progressing at a rapid pace. The world is looking at India with hope and expectation. The Embassy of India, Berne, has been continuously working during the pandemic in promoting India-Switzerland commercial ties. A few recent events organized by the embassy include agricultural products virtual networking meet with a focus on fresh fruits, vegetables, and floriculture in September 2020, Indo-Swiss Digital Cooperation Business Matchmaking Session in October 2020, and India Global Connect, India-Switzerland Buyer-Seller Meet in Gems and Jewelry sector in November 2020. Coming back to the webinar, our speakers for today include MISSP Knowledge Partner, T&A Consulting, and MISSP Legal and Tax Partner, Roddle Partner. If you have any questions during the webinar, please type them in the chat window, and we will collate the questions and respond at the end. So with those words, I would like to now invite the first speaker of the day, Mr. Tarun Gupta, CEO of T&A Consulting, for making a presentation on overview of the Indian economy amidst the COVID crisis. Mr. Gupta, this is all yours.
Thank you, Dr. Singh, and a very good afternoon and a very sunny afternoon from India, from the outskirts of New Delhi. It's been a while since we did our last webinar. It's been a few months, and we are, as the world is seeing, we are seeing hopefully the end of pandemic in sight. And we here in India have also been fortunate in terms of business activity coming fairly back to normal, as I will talk about the economic indicators as well. And hopefully for all of us, 2021 is the year where we move forward based on the background work done. And we are very pleased with the kind of response we've received from Swiss companies who have an interest in India and India positioning itself as an important player in the global supply chain. So today I have two presentations. My first presentation is about high level on the Indian economy and the reform journey. Reform journey is an evolutionary process, and this is something as a country we are convinced on that route. And I will talk about that. But before, in the next probably 15-20 minutes, my first presentation is about the macro picture about India and some of the reforms. So first, what are the high level thoughts about India? I always say we have 4 Ds of India: democracy, and we are leveraging that. Our 600 million people who voted in our electoral system, we are using that pipeline, we are using that infrastructure for our mass world's largest vaccination program. So first is democracy, vibrant, very proud. Second is demography. We are one of the youngest countries in the world with median age of 29, and this has also helped us in terms of managing the pandemic. Diversity, the country is very diverse, and for today's sector, you will see some of the geographical areas rich in minerals, other geographical areas rich in different type of agriculture commodities, and certain areas where we are seeing more refineries, energy. So really, we bring the whole India as a geographical landscape, which have different regions, have different strengths. And disparity, yes, not only income disparity. I'm looking at the disparity in terms of the states. Today, the top 8 states account for about 50% of India's GDP and about 60% of the consuming class. So really, in this message, 4 Ds: democracy, demography, diversity, and disparity. And one of the other takeaways from this slide is the massive urbanization, which is expected. We expect to move about 250 million people to urban centers in the next 10 years. And this is creating the demand for all our commodities into infrastructure. And also, as we move up the income curve, the consumption trend. With that, I move to the next. How's the Indian investment climate? You see, even in our April, September during the pandemic period, we had a 15% increase in our FDI. That says something. Whether you look at a half year. So we've been one of the very few countries who's witnessed an increase in FDI in 2020. And what we need as a country is to have this virtuous cycle of investment, savings, and capital expenditure. And why is that? So that we are able to leverage some of the advantages, whether it's lower cost of production, skilled manpower, natural resources, which we will go into details. So how, apart from 2020, what's been our FDI story? If I go back, India has since last 70 years probably, got about $700 billion of foreign direct investment, of which nearly 50% has come only in the last 6 years. And out of that, 90% of all the greenfield investments are allowed under automatic route. So really, it's the quantum of the FDI investment and the fact that 90% has come through automatic route gives an indication of the ease and the acceptance of foreign direct investment. But how do we compare vis-a-vis some of the other peer group countries? We were fed the acronym BRICS, and now there's a new acronym MIVIT: Malaysia, Indonesia, Vietnam, Thailand. And how does India rank? The table on the right hand side gives you an indication how we are ranked and how we have improved in ease of doing business. Significant improvement in ease of doing business in the last 5 years. And in fact, we are amongst the top 10 improver for the third consecutive year. One big advantage which India offers compared to our peer group is a large domestic market. And one of the questions which always comes up and I want to take head on is, how has pandemic affected India? Let the data speak for itself. How is the economy rebooting? Well, you look at our foreign exchange reserves at our highest levels ever. Our stock market, our highest levels ever. Ample liquidity. Look at manufacturing performers managers index, highest in a decade. We had announced a strong liquidity scheme. of about $43 billion, 70% has already been sanctioned. And the two most interesting is look at our goods and service tax collection. They are higher than actually December 2019. Our external debt is under control. So really we are all, as an economy, we are geared to take advantage of this uptick, which generally follows whenever there is a recession, a pandemic in the world, history tells us. And you look at our unemployment trend, it saw its peak when we had a massive lockdown, and it's really taken a sharp curve downwards. And so unemployment level are also back to our natural trend, which shows that the economy is rebooting. Let's look at some other parameters. In fact, yesterday, you look at the power consumption parameter. Yesterday, there was a news that our power consumption, I think it was yesterday or day before, at 9:35 a.m., peaked at 185 gigawatt, maximum power consumption, which gives you an indication economic activity is back and truly back. And I have a small informal barometer is my traffic. I am in Gurgaon, which is a suburb of New Delhi. It takes me the same time or even longer before it used to take pandemic. So yes, passenger vehicle registration or e-way bills, which is the most important indicator of freight movement, is back and above in terms of pre-pandemic. So hopefully these two slides give you a perspective on the economic activity levels post or now in 2021. Going back now, the four other points from the India attractiveness is CFID: consumption, formalization, infrastructure, and digitization. India is a consumption-driven economy. Nearly 56% of our GDP comes from consumption. And you look at our private consumption expenditure, it's nearly tripled in the last 10 years and is expected to more than double in the next 10 years. And this is the class which is driving the demand for commodities. Infrastructure, as I will talk about, for metals and mining, and this is for agri. And our history of any economy indicates that up to $1,000 per capita income, it's survival. Beyond $1,000, you start consuming, and beyond $2,000, the discretionary income spends. So in all our purchasing power parameters, India will be the third largest consumer market behind US and China. And what we have in front of you is a pyramid, which gives you an indication of the million of households on the dollar income level and where they sit. What we estimate is that the big change will happen in the middle class above $10,000 income level. This is where we expect that to reach about 100 million households by 2025. So consumption. Second is formalization. Now, what do I mean by formalization? We need to improve our tax to GDP ratio. The graph on your bottom left-hand side gives you an indication we are at about 17% compared to Brazil 34%, China 21%. Now, if we need to invest, we need to make sure that we widen our tax base. Widen it, but doing it in the most transparent and using faceless. In fact, we have started faceless assessment of income tax. So the effort is to improve. And if you look at the number of organizations, to bring about efficiency. Today, there was a study of McKinsey last year that India has about 600 odd firms above $500 million and about 5,000 firms between $40 million to $500 million. So really, we need to increase the number of firms in the mid segment to about 10,000 and the top end to about 3 times to 1,800. And what it encourages is better tax compliance and more productivity. You look at the graph that although the firms employing more than 100 people are only about 15 odd percent, but they account for over 88% of the net value add. And here I would also like to mention that respect for contract is a big thing, and our insolvency and bankruptcy code is a huge step in that direction. And I'm sure my colleague from Roddle and Partner will talk more on this aspect. So formalization. Third, moving to infrastructure. Well, last week there was a release that during the pandemic in certain months, we reached 72 kilometers of highway construction every day. And this financial year, which we end in India in March, we may have built about 11,000 kilometers of national highways. 11,000, which is nearly at 28, 29 kilometers of national highway every day. And we expect our run rate of infrastructure spend to be about $300 billion annually till about 2025, which is double our infrastructure, along with, and this infrastructure, I'm not restricting only to highways. We talk about railways, a big collaboration with Switzerland. We are looking to electrify our entire railway by 2030. We have high-speed corridors. Our Prime Minister announced recently metro work of 1,000 kilometers going on in over 20 cities. So really, we are trying to cover a lot of lost ground. Why? Because infrastructure leads to economic competitiveness. All our policy framework is geared towards making manufacturing more competitive, the Indian economy more competitive. And last point on my CFIT is digitization. Again, I go back to our vaccination program. It's fully digitized. We can track our vaccine from the moment it leaves. Every person gets an SMS. We will have a digital certificate. And all this is based on the infrastructure which we have built over the years. This is the India stack. I can go on about this slide for the next 30 minutes, which I won't. But the message is we have built a pipeline which is based on presence-less with our biometrics, paperless, all our digital lockers, cashless, where if you look at our digital transactions in October, they crossed $2 billion. Look at the base in 3 years, from 6 million in a month to 2 billion transactions. In fact, one of our leading e-wallet company has, I think they have close to 150 million active users. So really, and we've opened 6 years ago, 1/3 of our population had bank account. Now 80% of our population has bank account. We have over 400 million new bank accounts open. There has been a revolution in terms of our mobile users on internet, which is close to over now touching about 600 million people. So really, this digital pipeline has enabled more people on financial inclusion, more efficient in terms of our benefits which the government gives out through our direct benefits transfer scheme. And now we are also using this pipeline for our vaccination. CFIT, that's in a nutshell. And now I move to a high level on our reform journey. And I will move very quickly. Reason being, I've tried to cover a few of the points already. This slide talks about ease of doing business. I would like to bring your attention to the Global Innovation Index. We are into top 50 for the first time, and we plan to improve our spend of an R&D spend, which is at about 0.7% of our GDP, to 2% of our GDP, and look at our competitiveness ranking. And we are now at 43, and our aim is to move up on our competitiveness ranking. Moving next, Dr. Singh spoke about Atmanirbhar Bharat. This has these 5 pillars, wherein it's system driven. We build the infrastructure and use the power of our demand and supply. And so we have announced packages, and we have focused on reforms related to land, labor, liquidity, and loss. And this whole approach is ensuring we plug any gaps which impact our competitiveness or productiveness. So I spoke about our banking reforms. We are merging some of our public sector banks on our direct tax reforms. And why I take a pause on this is because Gaurav would be covering it. But the message here is our tax reform needs to be simpler, digitized, and transparent. Moving next, this is the single biggest tax change. Our tax rates now are competitive compared to any Southeast Asian country. If you look at new manufacturing, we are talking about 17% odd. If you look at our new corporate tax rate, it's about 25% odd. So really, our taxation, which used to be higher, is now comparable to any peer group. We have announced production-linked incentives ranging from 6 to 20% of your incremental production. We started with 2 sectors, pharmaceutical, because of the pandemic, to make sure we reduce our dependencies on APIs and key starting ingredients, and electronics, especially for mobile production. We have become one of the largest. And now we've rolled it out to these 10 sectors. This has been a huge success and one of the biggest driver of manufacturing in India and India for the world. Mining, this is sector which is relevant for us for our today's discussion. And what we have brought about is a very transparent bidding process in the mining. And we have allocated coal blocks which were earlier restricted only to captive. So we have opened that field. And India is very rich in resources. We have third largest iron ore reserves, fourth largest coal, fifth largest bauxite. But what was missing was transparency in terms of the whole auction process. So we've now brought about that in terms of our the way this auction process happens. And we've also looked at joint auction of bauxite and coal mineral blocks to enhance aluminium industry. And this is something which will have a huge impact on further investments into this manufacturing as well as in the mining sector. Moving on, touching upon defense, in terms of we are one of the largest importers of defense equipment, but clearly now the thrust is on local manufacturing. And we've brought about a very transparent offset policy and domestic aviation. If you leave aside the pandemic, we have the fastest growing domestic aviation market in the world, but we now want to bring in for MRO facilities, India positioning as an MRO hub. Space exploration, power distribution. In fact, there are Indian companies now who are collaborating with the European Space Agency, setting up operations in Europe. And also on power distribution, we had large number of transmission and distribution losses, currently still at 19%, but it's our aim to bring them down to about 10 to 11%. So we've seen large private sector participation in this power distribution, and also in the sanctity of the grid and setting up of the national grid. Logistics, I think this was a pain point for a lot of our foreign investors, and it's a concentrated effort for us to reduce our logistics cost from 14% of the GDP to 10%. We have opened our dedicated freight corridor. We have doubled our speed of our freight trains. In fact, we now have some dedicated corridors where we can run our freight trains up to at 100 kilometers per hour. Inland navigation, we have opened waterways because the cost is 1/5 that of road. So really we want to change the mix. We want to increase the share of railways and inland waterways in our freight transportation. We have rolled out FASTag, we call it, the electronic toll schemes, so that again linked to digitization, which leads to better toll collection, more transparent, and of course, your reduced lead time. And lorry, now a truck in India can travel close to 300 kilometers a day. We are getting up to the world average of about 400 kilometers a day. Land and labor reforms, I will let Gaurav go into more details on that. But essential message is that all this is, again, geared towards removing some of the baggage which we had and making sure it's fair, and also is able to have more people in formal job employment. What I spoke about formalization. Agriculture and farm reforms. This is a sector which is very close to our policy makers, because we are trying to have better price discovery, and the main aim is to double farm income. And all these steps which are geared towards, which I will speak in my commodity presentation, is towards ensuring that farmers get a transparent and a better price for their produce. And this has resulted in, and this is a work in progress, and we are hoping this will help a strong step towards India as an exporter of agri-commodities. I'll share this more details in my next presentation. These are some of the industrial clusters, and the key message here is 2 million square meters of industrial space is ready for possession in 3 to 4 months across these industrial clusters. That brings me to the end of my presentation. Over to you, Dr. Singh.
Thank you, Mr. Gupta, for a very comprehensive presentation on Indian economy and the aspirations and ambitions that we have. Let me now move on to the next presentation of the day, which is Doing Business in India, Legal and Tax Updates. The presentation is being made by MISSP Legal and Tax Partner, Mr. Gaurav Makhijani, who's Senior Associate at Rotterdam Partner. So Gaurav, skin is yours. Thank you.
Thank you, Dr. Singh. Yep. So, good afternoon and good morning, everyone. As far as the commodity trading is concerned, basically India allows different routes for making an inbound investments in India for global investors. And these routes can depend on the nature of investment to be made in India and the purpose of investment. Now, if I have to talk about the routes, they are foreign direct investments, which is primarily for making the equity investment or strategic investment in India in the form of having a entity in India or a branch office or project office in India. And then if you have to make a investment in the venture capital, you have an option of investing through FVCI, which is Foreign Venture Capital Investment. And if you have to make an investment in the capital markets, you have an option of registering as a foreign portfolio investment, and then you can invest in the listed equity or other securities in the capital market, which is regulated by stock exchange regulator SEBI in India. Then you also have an option to lend loan to the Indian corporates by way of an external commercial borrowing in both foreign currency as well as the Indian denominated currency. Then there is also an option of pooling your investment and then making an investment in India by way of an alternate investment fund option, which also have certain advantage from regulatory and tax perspective. So primarily I'll focus my presentation on the commodity trading. And as I mentioned that if you have to make an investment in the listed security or equity market in India, in the capital market, you can opt for a FPI route. Now, for making this investment, any FPI will then have to approach the local custodian, which is the depository participant which registered with the Indian Stock Exchange regulator, the SEBI. You make an application with certain supporting document and you get the license to invest as an FPI. Then to make an investment, you need to have a depository account in India and also an INR bank account with a local bank in India. Now this is required because all your investment and all your sales proceeds then can be repatriated through this INR account. And any FPI can invest in most of the transferable security with some restriction related to equity that for example, it provides that any FPI can invest in a company equity which can be restricted to 10%, and if it is a banking sector, then the investment can be up to a 5% of the capital of that Indian corporate. And the debt market is regulated by the Central Bank of India, which is Reserve Bank of India or RBI. Now, when you have a sales proceed or an income which you want to repatriate out of India, there are rules which provides that you need to pay necessary taxes in India. For that, you need to obtain a certificate from the local Indian chartered accountant, which needs to be then submitted to your banker. And once they have this certificate, then they will allow you to repatriate these funds out of India. So they have provided a mechanism to repatriate the funds out of India on the income made from the capital market investment. Now, coming on to the Indian tax framework, it's as good as any other European country would have. And basically, it's divided into two broad heads. One is the direct tax, which is governed by the Indian Income Tax Act, was framed in 1961. And any foreign investor would then have a treaty protection because India has bilateral tax treaty arrangement with more than 90 countries, including Switzerland. So any foreign investor making an investment in India needs to be aware of the local Income Tax Act. However, Indian Income Tax Act then provides that if there is any beneficial provision which a tax treaty provides, then it would be governed by tax treaty rather than the not so beneficial provision under the Income Tax Act. So that's a more beneficial provision option which any non-resident can claim. Now, India also has a transfer pricing regulation and a CBCR reporting, which is country by country reporting driven by the OECD BEPS program. So any investment which is made in India, and if there is a related party transactions involved, then a transfer pricing regulation or reports have to be filed in India, though it may not be applicable for any FPI investment because it's a direct investment made in the to the capital markets in India. Similarly, with the tax reforms and growing globalization, government has also introduced last year the India's digital tax, and it generally provides, if you are making any online sale or online services from outside India to any Indian to the Indian market, then you have to pay some equalization levy, which is the digital tax in India. As far as indirect tax is concerned, if you have any imports which have to be made in India, then it's governed by the custom regulation. And if there is a related party transaction, then it's also governed by a special valuation branch under the custom wings. India has then foreign trade policy for export and import related rules. And as far as Indian VAT is concerned, it has introduced goods and services tax, which combines all the state laws which was earlier applicable into a one consolidated laws, which is then beneficial for all the investor because they don't have to go into the local laws, and they can this is governed by one central laws of India. Now, as far as FPI tax consideration is involved, as I already mentioned, that there are specific tax laws applicable for making an investment in the capital market, and you need to have a license in India. You also have to obtain a tax registration in India, which is a permanent account number, a PAN in India. Then any FPI has to file their annual income tax returns in India. And to repatriate funds out of India, you need to submit a certificate from a local chartered accountant substantiating that the due taxes, whichever is applicable, has been paid, and then the bankers allowed you to repatriate the funds out of India. Now, there were a lot of litigation earlier regarding the FPI nature of income. When you make an investment in India in the capital market, it was always litigated whether it's a business income or whether it's a capital gain which you earn from selling the securities or derivatives. And also, when it comes to business income, there was a different rules altogether, that whether it's a speculative because you're not taking the delivery of a particular commodity, or whether it's non-speculative when you take the delivery of the particular commodity. So there was a lot of confusion and a lot of litigation. To avoid all those litigation, government has introduced a new rule back in 2014, and then it's been developing since then. And it simplifies the rule, and it provides that all the income which any FPI earns from Indian market, commodity market, will be characterized as capital gain and would be taxed accordingly. Now, the tax rates which are applicable for income of FPI from the commodity market or commodity trading is long-term capital gain tax, which is at the rate of charged at the rate of 10%, and short-term capital gain tax is charged at the rate of 30%. Now, long-term would means that you have held that particular commodity for a period more than 1 year, and if it is lesser than that, then you have to pay tax at the rate of 30%. Now, as I already mentioned, that India has this bilateral tax treaty arrangement with Switzerland. So to compute the capital gain tax liability, you need to see the provision of India-Switzerland tax treaty, and there you can explore a position that if you are a resident of Switzerland and making an investment into India in the commodity market or the capital markets, whether this will actually become taxable or not is another question which needs to be explored. Now, there are some beneficial provision of which advantages can be taken and needs to be seen in detail. Now, apart from commodity market, if an FPI has an investment in equity or debt market, they can also expect some income in the nature of interest from debt market or dividend from the equity market. And therein you need to see what tax rates are applicable. Also, then you need to see the tax treaty arrangement. Generally, interest and dividend would be taxable in the hands of recipient now, and would be taxable at the rate of 10% under India-Switzerland tax treaty. So that's a beneficial provision which is there under the India-Switzerland tax treaty. As far as goods and service tax or the Indian VAT is concerned, that would become applicable only if you invest in a commodity derivatives and then you settle it by way of a delivery. Then you have to see what commodity derivatives you have invested in and what is the HSN code. And at the time of making a settlement through a delivery and then selling it off, you need to see whether any Indian VAT is applicable on that particular commodity in line with the HSN code, and then you have to pay the Indian VAT on that. Also, there are certain brokerage charges which we'll have to pay to a broker while making an investment in the capital market. So there could be some GST which would be applicable on that. That can become a cost on your investment. So you have to take care of the that particular cost when you think of investment in India. And then when you invest in a capital market in India, you have to pay some commodity transaction tax, which is CTT. It's generally levied at 0.01% of the value of the transaction, but this is applicable only on the products which are a commodity which are other than agriculture commodity. And also there are certain rules which has been introduced, like if you settle it through a delivery, then a lesser commodity CTT is applicable on your transaction. So overall, if you see the entire picture, the government is focusing on improvising the tax systems in India, and therefore it has provided. It has tried to reduce the tax litigation in India by providing simple norms for income characterization and a single tax bracket for all your investments, so that there is no confusion in the minds of any investor. Also, there are, as Mr. Gupta mentioned in his presentation, that there are new rules for faceless assessments and faceless return filing provisions, which the Indian government has provided. So all in all, they are focusing on the easier tax norms and the rules to compute your tax liability and reducing the tax litigation. Apart from that, they're also focusing on providing the better tax administration by introducing faceless scheme, wherein a tax authority, when they have to ask a detailed tax audit scrutiny from the investor, they will issue you a notice online, and then every proceeding will be done online, so that you don't have to invest time in visiting the tax office. Also, it creates transparency because everything is online and there is no hidden aspect on any communication with the tax authority, and there is always a proof or trail which is created. So this was it from the tax and legal perspective or regulatory perspective for investment in commodity trading market. I'll hand over to Dr. Piyush Singh now. Over to you, Dr. Singh.
That very handy and practical presentation from the legal and tax perspective. We have a few questions which we'll come back to during the Q&A session at the end of the webinar.
Sure.
Let me now move on to the final presentation of this webinar, which is overview and opportunities in the Indian commodities trading sector. So, Mr. Gupta, again, over to you for presentation. Thank you.
Thank you, Dr. Singh. I'll just pull the presentation. Just bear with me. Yeah. Okay. Thank you, Dr. Singh, and thank you for the audience for the patience. In this sector, in this presentation rather, I would go into details about three segments: agri-commodities, metal and mining, and energy. And what the message is in these segments: India as a production hub, India as a consumption hub, and India as an emerging export hub. So these are the 3 points I'll try and cover, and what is the mechanism, both for especially at the exchange level, in terms of how is the formalization happened on these sectors. Now, when I spoke about the growth projections about India, how we need to grow to reach our vision of being a 5 trillion economy and then a 10 trillion economy, our increase in per capita income, our spend on infrastructure, all this leads to consumption of commodities. And if you look at India's production, we are ranked, and let me just go to the next slide. We are ranked in several commodities. We are ranked amongst the top players for exports, And in several, we still have import dependency. For example, if you look at crude oil, 85% of our requirement is met by imports. Gold and diamond, and we love our gold. We have not significant production. So again, large level of imports coming into these segments. But if you look at some of the agri commodities, we are right up there, whether it's wheat production, rice production, in terms of pulses, edible oil, yes, we have some import dependency. And on metals and mining, most of the metals, iron ore, aluminium, zinc, coal production, for example, nickel, yes, we are dependent on imports. So really, it's a healthy balance. And some trends have changed, especially in agri commodities. What is the trend change and how India has moved a long, long way of in terms of agriculture. Let's just step back. When we got our independence, self-sufficiency in the food was a big thing, right? We wanted to reduce our dependency on a critical import of wheat, for example. And we had the Green Revolution. And now we have moved from self-sufficiency to, dare I say, largest level of buffer stocks. Today, our yards are overflowing. I think we are double our minimum buffer requirement of our agri commodities. And even during the pandemic, our exports, for example, of agri commodities increased from April to September to about $7 odd billion from about $5 billion in April, September to 2019. Because one of the big fear in the world was, will we have enough food? And India really maintained its position, emerging position, as one of the leading agri exporters. In fact, India is amongst the top 10, top 15 exporters of agricultural products. And we have maintained that. And but what we need to now do is improve our share in agri exports. And we announced our agricultural policy. So what our aim is of our agricultural policy is, for example, I mentioned we are one of the largest production of wheat, but we are ranked, I think, number 34 in exporters of wheat. Yeah. So what we need to now improve is our share of agricultural exports. Today, India's share of world agricultural export is about 2.5%. And we saw in the last figure about $35–40 billion of agri exports we do annually. Our vision is by 2025, we need to increase this export to $100 billion. And we need to increase our share of agricultural exports in the world to about 5% from 2.5%. What will all this result? All this will result in improvement of the farm income. That is the underlying goal. How do we double the farm income? So we have announced a series of farm reforms. We are making investment in agri infrastructure as irrigation, warehouse, cold storage, and we have a plethora of agri-tech startups, whether it's for crop monitoring, whether it's soil monitoring, weather pattern, a huge trend on agri-techs which are improving our yield as well as our farm losses on that. So what you are seeing on your top right is the blue revolution in terms of our aqua, white revolution for our milk production. We are the largest producers of milk, and the whole year of pandemic, we never had the slightest of trouble in terms of availability of milk. It's commendable. And this is one of the largest cooperatives in the world. And of organic farming. We expect our organic farming to be a $10 billion production value in about 5 years' time. And there are certain states in India, in Northeast, for example, who are fully organic. So the message on this slide is, earlier we were self-sufficiency, now large production, and how do we maintain our position as a reliable agri exporter. These are some of our figures for exports, what you see. I mentioned rice, of course, bovine meat, and some of our imports of palm oil, soybean, so these are some of the sunflower. So these are some of our key exports and import of agricultural commodity, and all our farm reforms are geared towards ensuring there is predictability. So for example, what we are saying is that uh, the Essential Commodities Act, which used to restrict the amount of commodity you can store, that can be removed so that our exporters have better visibility and our buyers know that there will not be any short-term misses on meeting the commitments. So these are geared towards ensuring that the farmer receives a better price for their produce. Moving next, metals and mining. I mentioned that about India's position for iron ore reserves, for bauxite reserves, for coal reserves. And you see, and transparency in mining inquiry. Earlier, and this has resulted in the number of operational mines now increasing to nearly 1,500 in the last few years. But more importantly than that, it is also linked now to making sure that this improves our cost of production of our industry. And why this is required? Because of our great spend on infrastructure. So what is the trend? For example, when we look at our power, this creating demand for aluminium and copper and coal, of course. When we look at our infrastructure, there's a demand for cement, which is creating a demand for coal. And now we are permitting 100% foreign direct investment in these sectors. Private ownerships is being encouraged. So infrastructure, the industrial production, and we are blessed with these resources for metal and mining. What was missing was a framework. What we have provided now is a framework. One important characteristics of Indian metal and mining, which I should highlight, is the use of recycled metals. It is estimated that about 30% of our requirement of metals by the SME is recycled metals. So that part's a huge part of our, at the moment, a lot of this trading is informal, and we need to bring a more formal mechanism for the recycled metal. On your slide here is we are one of the largest producers of steel globally, and large exporters of steel to some of the developed markets. And we leverage on our strength of iron ore reserves. And what you see now are three key metals in terms of and where we are seeing our exports. Aluminium, clearly India is the fourth largest producer, and we are increasing our aluminium production capacity for meeting our captive demand as well as potentially for exports. Zinc, which is mainly used for galvanizing. And so these three are our key, and copper are our key metals in mining, which are seeing maximum level of production and trading. Moving on, energy sector. If you look at the slide, it says that our current consumption, which was 2018, was 150 gigawatt. Now we are at 188 gigawatt, as I mentioned, and it's estimated to cross 600 gigawatts by 2040. Our per capita power consumption is still about 1/3 of the world average, 1/3. So we have 18% of the world's population, but we produce about 6% of the world's power. A, we need to increase our capacity. B, we are improving our grid quality and network. And third, we are slowly and surely changing our energy mix. Coal will continue to play an important role, as the next slide would indicate, but we are one of the fastest producers of renewable energy. Our targets are very ambitious. We are over 200 gigawatts of renewable energy we want to have, of which we want to have at least over 100 gigawatts of solar power. So renewable energy mix, we have some of the lowest tariffs on new solar energy, which are as low as 0.4 Swiss franc per kilowatt hour. So really our energy mix is growing, but our dependency on coal will continue to be there in terms of the demand, but the percentage may change. And as a result, our coal production, there's been a significant increase in our coal production, and both because of Coal India Limited, and also we are allowing now private sector participation in this. Moving on, in terms of refining, currently our refining, we call it, Dr. Singh mentioned, we are the world's pharmacy, and we are also one of the biggest refiners, Asia's refiners. Our current capacity is about 250 odd million tons, and we want to double it to about 455 to 500 million tons by 2030. And you look at our refined oil exports, we are setting one of the biggest oil refinery on our west coast in the state of Maharashtra. And we've got big interest from sovereign wealth funds, large players, to participate in this. So really, India will be one of the largest places for refineries and very competitive refining ability to do refinery across all grades. And we expect to maintain our position as exporters of refined oil. Now, moving on to the exchanges. India, for example, in 2018, and Gaurav touched upon, allowed foreign entities to invest, provided they have exposure to the Indian physical commodity market. These entities are known as eligible foreign entities, and they are allowed in jurisdiction where SEBI, which is a regulator, has a bilateral pact, and they need to have a minimum net worth of $500,000. So surely, and we are allowing now to deepen our commodity derivatives market. But what is the history of that? Sorry. But what is the history of our this? The history of our market is that prior to 2014, prior to 2004, we had a lot of regional exchanges, right? And thereafter, we allowed what we allowed was our national exchanges to be set up. And now we have 6 large exchanges, and this resulted in the formalization of our commodity derivatives market. We started with allowing investment only in our agri commodities, and thereon we allowed investment also in our metals and mining. So really we brought about a lot of focus. These national exchanges brought about a lot of focus on bringing this trading on our platform. There we also have what is known as, we also set up a warehousing, a regulatory authority, so that when you have your when you deposit something in warehouse, you get a receipt through which you can go to a financial institution and avail of loan against those warehouse receipts. What we have now is in our commodity exchanges, we have now India, we have some of the large exchanges like MCX, like our NCD, National Commodities and Derivative Exchange. In fact, it is estimated that our MCX has become the largest exchange in gold and silver, second largest in natural gas, and third in crude oil. But we still need to take some more steps, which is at the moment we have absence of financial institutions, absence of product innovations, the cost of trading. So these are some changes where government is making reforms. We are also looking at a national exchange for spot market, because at the moment there is a big ideally the derivative and spot market should converge. So on the derivative side we have a fantastic market, but we now need to bring more formalization on the spot market. But what we have seen is a presence of large commodity players. As you would see on this slide, large commodity players are already present, and sometimes they start off by setting up a sales office, but thereafter it gradually moves on to their permanent office. Most of these players are spread across agri commodities, metal mining, and oil. With that, I come to the end of my presentation and will be happy to take any questions. Over to you, Dr. Singh.
Thank you, Mr. Gupta, for that. I would say detailed, deep dive presentation into the commodities trading sector and the particular subsectors that we are discussing today. That brings me to the Q&A session of this webinar today. I have a few questions with me. I should mention to the audience that if you look at the upper right side of your screen, we have put a handout on commodity trading sector, which you may like to download. We also have a poll ongoing, which you may like to respond to. So, Mr. Gupta, maybe I would ask, I would request you to again appear on the screen for a few questions that we put to you. The first is, what are emerging areas of opportunity in commodity trading with India on account of the much talked about reshuffle of the global supply chain?
Dr. Singh, I'll break this question. One is definitely with regards to agri commodities. That is one thing where the pandemic has shown that India has been one of the reliable suppliers. In fact, as my presentation indicated, our agri exports grew during that time. And we see a world moving towards having a reliable source for agri products. Competitive, of course, and reliable. And with the quality standards. So we already have quality standards and we are putting in these quality standards in place. That's number one. Second, the refined oil, I think we already have a strong position there, and the proposed capacity expansion will ensure that we continue to retain that position. As far as metals and mining is concerned, I think our reforms in the mining sector will go a long way in creating a strong back end, which was sometimes missing. So now, with the transparency in those mining reforms, there is more predictability on the supply chain for these important metals and minerals. So agri is probably, I would say, number one. Metal and minerals due to the reforms, and refining we already have a strong position.
Thank you. Thank you, Mr. Gupta. Given that you have made two presentations, so you have more questions today. The second question goes that what logistical hurdles can be expected while dealing with the Indian market? So again, that's a very pertinent question which we've also been discussing within the government during the pandemic.
I think, for example, the reform of the Essential Commodity Act, that's important because now we are able to store the commodities in larger volumes and take care of the cyclical demand. Yeah. So earlier, the problem was, number one problem was, for example, warehousing. Yeah. Because the reforms did not support the large warehouses, but now we are setting up large warehouses. And I spoke about the Warehousing Regulatory and Development Authority, right? But it's important that we have seen some of the large private equity players coming into this space for setting up large warehouses for agri commodities, registered under WRDA. And that is brought about liquidity in the market. As a farm, I could deposit and I could raise money against those receipts. So one big challenge was on warehousing. Cold storage is work in progress. Significant work has been done, but a lot of our cold storage is still focused on potatoes. And we are improving our cold storage. So that was one challenge from a foreign. Second challenge was the large warehousing, which I think we have made significant progress. Third would be the movement of commodities within India. I spoke about our dedicated freight corridors. We spoke about internal navigation because it was expensive and it took a long time. So these are some of the logistical challenges. And of course, ports. You look at our reduced time at ports. Earlier, to unload a ship, it could take 4 days. Now we brought it down, I think, to 48 hours, and the aim is to get it down to even lower. So these were some of the logistical challenges. Port capacity was a logistical challenge. But now with all our investment in port infrastructure and with Sagarmala port connecting ports with roads, these will hopefully reduce the logistical challenges which foreign buyers or investors used to face.
Thank you. Thank you, Mr. Gupta. I just have now time left for one question, so I'll ask Gaurav to please come on the screen. The question is, what currency restrictions are there in commodities trading for non-Indian company? So if you could respond to that.
Okay, sure. So for making an investment in commodity market, capital market in India, first I mentioned already that FPI needs to have a license in India. Apart from that, you need to have a depository account with a custodian. Also, you need to have a bank account, which should be in the Indian rupees. So you cannot make investment directly. You need to have an INR bank account to make an investment. So that's a restrictions which is provided by the regulators to make any investment in India. Apart from that, then there are certain cap for making an equity investment or a debt investment. And also you do not get any interest on that particular INR bank
Mhm.
account in India if you are an FPI. Being an FPI, you cannot even borrow the money in India. So that has to be investment coming
Okay,
from abroad.
thank you. I think the question has been answered. And if there's any supplementary question, please write to us. I can just say that. So with that, we have come to the conclusion of this webinar today. It has been a pleasure to host this webinar. I would like to thank the MISSP knowledge partner, TNA Consulting, and the legal and tax partner, Rodel & Partner, for putting in their contributions. I would also like to thank all the participants from Switzerland who have joined us. I'm sure that this webinar will go into further diversifying India-Switzerland trade and increasing the commercial ties between the two countries. This whole webinar will be has been video recorded and would be uploaded on the YouTube channel of the embassy. We'll also be putting all the presentations made today on the MISSP website, from where you can download the presentations if needed. So with those words, again, thanking all of you and wishing you a great day ahead. Thank you.